Welcome back to the Inside ETF video series from ETF.com. I'm Drew Voros, ETF.com editor-in-chief, and I'm happy to welcome Sean O'Hara, president of Pacer ETFs. Welcome, Sean.
Thank you for having me.
Sean, tell us a little bit about Pacer ETFs. You have 15 ETFs out there, $3.5 billion in assets. You've been around 3 or 4 years.
Right.
You've climbed a big hill.
Yeah.
So tell us a little bit about some of your main products, which are trend pilots, which a lot of people may not be familiar with that term. Can you quickly tell us what that means and how your fund, those are your major funds?
Yeah, so we sort of think of ourselves as a strategy-driven ETF shop. We focus on 3 words: innovative, disruptive, and unique. So there's a lot of big ETF companies that have a lot of low-cost beta products. We're not going to be in that business. So the trend pilot stuff is fairly simple. It works off something everybody probably knows about, or most people know about, which is the 200-day simple moving average. It's been around for a long time. A lot of people follow it. It tends to indicate when there's a positive trend in the market and a negative trend in the market. So what we do is we have 4 trend pilots: a large cap, which is the S&P 500, mid cap, mid cap 400, NASDAQ in Europe. If that index is above its 200-day moving average, we own the index exactly like the index provider says. When the index falls below its 200-day moving average, then we start to shift the portfolio to treasury bills with an eye on managing some of the downside risk. We don't want to stay in equities and ride it all the way to the bottom. And so this strategy is not new, and people could do this on their own. The only difference is that I don't think they could do it as effectively or efficiently as we do, because inside of the ETF, the big advantage we have is the tax advantages of an ETF. So when we rebalance, we're able to rebalance without the capital gain.
So we've seen a downturn in the market. How does your fund react to that?
Well, last year was a pretty good year for the trend pilots. The S&P 500 product, we were up for the year even though the S&P was down. The NASDAQ product was up about 8.5% for the year, and the NASDAQ was flat. Mid-cap product was flat for the year even though the mid-cap index was down like 12%. And it's mostly because we moved away from equities in October and early November. So it worked okay last year, but that's really not the perfect market for it. I mean, that wasn't even a bear market yet. So
when things move, how does that move? Is it active? Is
No,
it an index, or is there an automatic
It's automatic.
system?
It's 100% rules-based. We have this very public, transparent set of rules. And when it's time to move, essentially the portfolio gets rebalanced away from the equity index into a treasury bill index.
So you also have another set of funds called cash cows.
Correct.
Which sounds great.
Right.
What does that even mean?
Well, we think it's a nice name as far as branding, or catchy, if you will. That's why we trademarked it. But the cash cow series is essentially, we don't want to own the whole index. So we'll take an index like the Russell 1000, screen it for just 100 stocks with the highest free cash flow yield. And free cash flow yield is the free cash flow that the company generates divided by its enterprise value. So think of it this way. If you could buy 2 stocks that both produce $2 worth of cash flow, but one traded at $10 and one traded at $20 a share, you would be better off buying the one that's trading at $10 because you're buying $2 worth of cash flow for $10. So that's the premise behind using free cash flow yield. We think it's an indicator of a healthy balance sheet, a quality company, one that can grow and sustain its dividends over time, and then one in tough times also has enough cash maybe to acquire some of their competitors or to build out their business. And there's 4 flavors of that as well. There's large cap US, there's global, there's international, and then there's small cap, which is the little cow, that's CAF, the ticker CALF. And so it's a value strategy, but it's different than most core value in that we're going to be underweight traditional value sectors and overweight sectors that value people don't participate in. And so if you're looking for a complementary strategy in your value sleeve, this is a great addition because you're not just putting more of the same kind of stuff in a portfolio.
How did you get, I mean, you've raised $3.5 billion in assets, very tough hill to climb for a new issuer. Quickly tell me, like, how did that happen? How's your distribution? Do you have your own, or do you use a platform?
Yeah, no, we do. It's 3.6 billion, by the way. So
okay,
the last 100 more, but we focus on a model that we have been using for a long time. My partner and I have been together 34 years. We've been in the distribution business that whole time. We believe in a heavily wholesale-based model. So we have currently 30 external wholesalers in the field. We're going to try to push that number up to about 40. But what we think is that for the financial advisor to understand what we do, they really need to have somebody come explain it to them in person.
Absolutely.
And so we think that's a difficulty for some people but an advantage for us in that it's hard to replicate that part of our model. And so we focus on in-person visits with financial advisors. We do social media and video and all those other things. But the core strength of what I think has got us where we are is our focus on wholesaling.
So finally, we're here in Hollywood, Florida, at the biggest ETF conference in the world, Insight ETFs. What do you get away from this?
That the business is growing and vibrant and expanding, and there's a big giant tent here, if you will. It's still going to be dominated by the big guys that are in the business of racing to zero fees, but there's a lot of providers and issuers in this room that are really building innovative products that solve problems for clients, and I think that's all good news for the end investor.
Well, Sean, thank you for stopping by the ETF.com SIBO booth, and I want to thank everybody for watching, and continue to watch our video series from here at Insight ETFs.